Good morning, everyone. Welcome back to Your Money Matters. I'm Angela Giroux, publisher of the Bauman Letter, with Ted Bauman and Clint Lee today. Now, if you're interested in finding out more about the Bauman Letter, there is a link below with more details. I invite you to check it out. And today we're going to cover, of course, the election. Now, just to let you know, we're recording this on a Monday. And I imagine even when you're watching this on Tuesday, we're not going to have any idea what's going on. And possibly even on Wednesday, we're not going to have any idea of what this outcome is going to be. But the question that's really facing investors is, how do you prepare for all of these possible scenarios that we're facing? So Ted, let's start by looking at those possible scenarios.
Right. So from the perspective of the stock market, I think there are three potential outcomes. And again, I just reinforce, these are not political outcomes, they're market outcomes, what the markets perceive as being good or bad. The best outcome of all would be unified control of all of the legislative and the executive branch by one party. And under the current circumstances, that means the Democrats. The markets have made very clear, all the major investment houses, all the analysts have said, this is a good thing because it means money would flow from Washington in the form of some kind of stimulus and probably all kinds of investments in the economy, infrastructure, technology, healthcare, and that would be bullish for markets. It would outweigh any negative from the tax side. So that's the outcome, frankly, that the markets are hoping for. I don't know how else to put it. The second one is a extended period of contestation over the results, and that would be deeply negative, I think, in the short term for markets. I may be wrong, but I think the markets would be very, very negative, be very bearish about a 4 or 6 week period of legal contestation, accompanied by lots of action, in civil society. And that would mean that even if we don't know what the outcome is, the process itself would scare the market. The third possibility is that we get a clear outcome, but the Republicans hold the Senate. And as one analyst said in an article that you shared this morning, Angela, that would be, in a sense, be the worst possible outcome for markets because they know that it would mean more gridlock and no action on these things, which means we would basically carry on as we are now, with the only difference being that we'd have a Democrat in the White House, and instead of supporting the current president, the Republican Party would be focusing all their energy on undermining that Democratic occupant. Not good for markets.
All right, and Clint, let me ask you, how are the futures markets anticipating things right now?
Actually, kind of surprisingly, the futures markets are very bullish, or at least bullishly positioned. And you can look at that with futures contracts tied to the S&P 500. That's just a popular way for traders to get exposure to the stock indexes. It's similar to buying an ETF, but one of the nice things about tracking these futures contracts is we know kind of what the net long and short position is out there right now. And once again, speculators are positioning very bullishly, and I'll show you a chart to highlight that fact. Right here, this shows the net positioning, once again, in those S&P 500 futures contracts. And this is the largest net long, so betting stocks will go up, the largest net long position in about 2 years. You have to go back to sort of mid to late 2018 to find similar levels of bullish positioning. So, whether or not that's bets on the election outcome or sort of that buy the dip mentality coming in. But I think one thing that's important to understand with these contracts is that once again is sort of this market level bet on stocks versus really disaggregating what's going on underneath the hood, separating out sort of those expensive areas of the market to those cheaper areas of the market where we've been talking about a rotation here recently, some of the opportunities that we see in some of the value space and some of the cyclical sectors that are out there. Because even with this pullback that we've had, market valuations overall are still expensive. And I've got a chart to highlight that point. Now, we've talked about the cyclically adjusted PE ratio before, and that sounds like a mouthful, but really all that is just taking the current price and comparing it to an average of earnings over time. So that way you're smoothing out the business cycle. And here's a chart of how that looks historically, going back about 10 years or so for the US, but I wanted to compare it to some other market regions where we're seeing much cheaper valuations. And a lot of those exist within some of the emerging market countries. So You look at, what I think is interesting is you look to the left-hand side of this chart, and these are all starting at about the same point, but then over the last decade, you really started to see the divergence in these valuations. So you've got the U.S. right now, this yellow line, north of 30 on their PE ratio on that measure, versus India, the orange line, China's the blue line, and Korea's the gray line, all much cheaper, trading more or less sideways or lower to where they've been about 10 years ago.
And now, Ted, you did point out that there's 3 possible outcomes that we could be looking at. 2 of those, and again, this is according to the market, this isn't anybody's personal preference, 2 of those scenarios would be negative. So that makes it likely we might have a negative outcome, this time Wednesday, we'll say. So how do we prepare for that?
Well, I think the first thing is to recognize that we are going into this in an overvalued scenario. In other words, the markets are primed for some sort of a correction. There has been a tendency for people to bid up the prices, particularly of growth stocks, on a long-term basis, expecting that over a 2 or 3 or 4 year time frame, they will grow into those valuations. And here's a chart that shows how those bets line up. This chart shows the United States. This is again basically what Clint was saying, but this shows the US versus emerging markets in Asia Pacific, the Americas overall, and in Europe. And right now, the United States is significantly overvalued. So what that means for the average investor, I think, is that if there's a negative outcome, a lot of the assumptions behind bidding up those prices in the expectation of future growth will be called into question. They'll be saying, well, maybe the US economy, the global economy, isn't stable enough to provide the returns we're expecting. That would lead people to pull money out. Now, here's a couple of charts that show that to a certain extent, this is already happening. Now, this chart shows that the fund flows coming out of US equity markets, out of the market, in other words, people taking money out of US equities dwarf all other flows. I mean, we're looking at just huge amounts of money moving out of US equities, moving out of small and mid caps. A slightly lower amount is coming, actually a lot lower amount is coming out of emerging markets. Now that tells me that investors are hedging their bets. They're moving to cash, they're moving to bonds, even though bonds don't return anything, because they want to see what's going to happen. Now, my prediction is that this could be reinforced, this trend could be reinforced dramatically if we have a negative outcome. It'll be quick if there's contestation, if we move into legal battles and street battles and things like that. And you could see a very rapid shift of money out of US into emerging and even European markets. But over the longer term, if we had a hung government, as it were, then I think we'd be looking at something like a shift in investor attention to parts of the world that are doing well. Here's a chart that shows a couple of major Chinese internet stocks, as well as the emerging markets. I think it's basically a technology ETF, and it is basically beating all of, or it's beating Amazon. Amazon is the red line. Amazon is actually on its way significantly downward at the moment as a part of that pull of money out of US equities and into these other parts of the world. And so my prediction is that if there's a negative outcome in the sense of contestation, there'll be a sharp drop in American equities and a potential rise in global equities. It may take a while because people will initially pull money out of all equities, but I think eventually they will start to move towards particularly Asian, because they're doing better in terms of COVID, and that will basically pull money in. The second thing is, if it's a hung government, I think, again, it'll take a little while, but it just means that the rest of the world's going to be more attractive for putting money in than the United States. So those are the predictions, and I think they line up with what we've been saying about rotations, particularly into foreign markets, something that we've advised people to prepare for.
And I think, of course, that it's worth mentioning that we do have several emerging market opportunities in the Bauman Ladder model portfolio, and they're doing very well.
They're our best performers.
Yeah, they're doing
almost
great.
our best performers. Yeah.
Now, to close things, I'm actually going to throw it to you, Ted, because like most Americans, I'll probably be drinking and trying to sleep through this election as much as I can tomorrow because my stomach is in knots. But you had some really comforting words in today, being Monday, our Bauman Daily. So just hoping you could share some of that with our viewers.
Well, thanks, Angela. Look, basically my philosophy, I mean, I've seen a lot of the world. I've seen a lot of political regimes. I've seen a lot of governments come and go. And bottom line is we are all responsible for our own fates. We have to react to government changes and to what happens at the top on the basis of what's good for us and for our families and our friends. And as investors, I think the critical thing is, just to remember that there are things we can change and there are things we can't change. And this is where it's important to know the difference. And right now, we can't change the outcome of the election. We won't be able to change it after it happens either. But what we can do is remember that we have choices available to us every single day, and we can act on those choices. And those choices, if made correctly, will turn out better for us, both as individuals and as investors.
Love it. Thank you. I'm going to keep reading that article over and over.
I'm glad you liked it.
All right. Thank you, everyone, for watching. And of course, thank you, Ted and Clint. Have a nice day.
And just as a reminder, if you are interested in reading that article and others, if you're not already subscribed to the Bauman Daily, you can do so on our website.
Completely free.
All right. Thanks, folks. Take care.